Imagine you are holding a stock, right? And just a few months ago, this thing was flying high, trading at nearly $60 a share.
You're feeling brilliant.
Exactly. You feel like a genius. You're riding the wave of the future. But then uh, gravity hits.
And it hits hard.
Yeah, you watch in absolute horror as it just plummets, shedding value week after week until it crashes to under $9. I mean, every technical indicator on your screen is flashing this terrifying neon red sell signal.
Right, total panic mode.
But then,
Yeah.
just as you're about to throw in the towel, it violently spikes, over 14% in a single day.
Which is wild.
It is. So you have to ask yourself, are you looking at the ultimate undervalued buy of a lifetime? Or are you just reaching your hand out to catch a falling knife?
I mean, that is the ultimate psychological trap for a trader. You see that massive green candle on the chart, the momentum shifts, and your brain immediately just panics.
Fear of missing out.
Exactly. You think you're missing the absolute bottom.
And that is the exact dilemma we're tearing into today. But before we get to the bottom of this chart, do us a quick favor. Like this video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave a comment with your feedback. We want to know where you stand on this one.
Yeah, let us know in the comments.
So let's set our target. We are looking at NuScale Power Corporation. Ticker symbol is SMR. Today's date is April 16th, 2026.
Right.
And our mission for this deep dive is to synthesize the real-time market data, the comprehensive annual financials, the technical analysis, and some highly suspicious insider activity.
Very suspicious.
Yeah, we need to figure out what is really driving the chaos behind this ticker.
Because we are dissecting a classic battleground stock here. I mean, the bears and the bulls are living in two completely different realities right now.
Totally.
But please remember, while the data we're exploring is incredibly compelling, nothing in this deep dive is financial advice.
Never.
This is an exercise in critical thinking, right? And market mechanics. We are here to analyze the machinery of the market, not to tell you how to manage your portfolio.
Okay, let's unpack this. Because a stock chart is essentially just a mood ring for the market. It shows us fear and it shows us greed.
That's a great way to put it.
To understand the fundamental debate happening right now, we first have to map out the recent chaos. Like, define the short-term strength versus the long-term weakness. NuScale closed just under $12, $11.71 to be exact, yesterday on April 15.
Right.
But just 2 days prior, on April 13, it hit a terrifying 52-week low of $8.85.
I mean, you are talking about wiping out billions of dollars in market capitalization in just a matter of months.
It's staggering.
Back in October of 2025, this stock was trading near $57, $57.42. A drop to under $9 isn't just, a correction. It is a structural collapse in investor confidence.
And the volume we are seeing right now is completely unhinged. Yesterday, they traded over 58.7 million shares.
Which is huge.
Yeah, more than double their 10-day average. So you have this massive collision of institutional algorithms and speculative retail traders. And the technical signals, completely schizophrenic.
They really are.
On a long-term basis, the trend is severe. The stock recently suffered a death cross. For anyone tuning in who might be unfamiliar, what actually happens in the market when a stock hits that point?
So a death cross occurs when a stock's short-term moving average, usually the 50-day, which for SMR was at 1251, drops below its long-term moving average.
The 200-day, right.
Exactly. The 200-day was sitting way up at 2724. So it sounds like this spooky term designed for financial television, but it has very real mechanical consequences.
Also,
Well, mathematical trading models run billions of dollars in the market today. When that cross happens, it mathematically confirms to those automated systems that the long-term momentum has definitively broken downward.
so it's like a trigger.
It acts exactly as a trigger. Algorithms begin automatically selling or shorting the stock, which creates this self-fulfilling prophecy of downward pressure.
Okay, so you have these massive supercomputers pushing the stock down, but then we have this sudden, violent, short-term reversal. I'm looking at the momentum indicators, and they are screaming buy right now.
Yeah, the short-term signals are flashing green.
The relative strength index, the RSI, is at 69.35, pushing right up near overbought territory on this bounce. And the MACD is at 0.534, flashing a rare daily buy signal.
Right.
We have immediate resistance sitting around $14 and supposedly a concrete support floor down at that 85 to 914 mark. So I got to ask, is this chart like trying to catch a falling knife? Or did we just watch a rubber ball hit the absolute pavement of that 85 support floor?
We have to look at the mechanics of why retail traders often get trapped in these exact momentum shifts.
Okay, lay it on me.
It comes down to a fundamental misunderstanding of what a bounce actually is. When a stock falls as violently as NuScale did, from 57 to 8 short sellers make an absolute fortune.
Right, the guy's betting against it.
Exactly. These are traders who borrowed shares and sold them, betting the price would fall. But to actually secure that profit, to lock it in, they have to buy those shares back in the open market to close their positions.
So that sudden buying pressure we saw isn't necessarily new investors believing in the company, it's just short sellers cashing out.
Precisely. It is a mechanical event called a short covering rally. It's not necessarily a fundamental change in the company's outlook.
That makes so much sense.
Yeah, retail traders see a 14% spike, assume the bottom is in, and jump in to chase the momentum. But once the short sellers are done buying back their shares, that buying pressure just poof, evaporates.
And then what?
If there are no fundamental buyers left to step in, the stock rolls right back over. It's what Wall Street calls a dead cat bounce. Yeah. Those short-term technical indicators you mentioned are just reacting to the sudden velocity of the short covering. But that heavy death cross looming overhead, that tells you the broader gravity is still pulling the stock down.
Wow. Okay, so a technical chart can only tell us what traders are doing today. To see if that 85 floor is actually justified, or if it's just a temporary ledge before another cliff, we have to look under the hood at their 2025 annual financials.
This is where it gets real.
And let me tell you, it is a bloody scene.
The financials are the absolute crux of the entire debate here.
Let's look at the income statement. Their total revenue is actually shrinking. They brought in $31.48 million in 2025, which is down from $37 million the year before.
Going in the wrong direction.
Yeah. And their net income, a staggering loss of $355.79 million. The trailing 12-month earnings per share is negative $2.17. They are bleeding cash.
It is a phenomenal amount of capital to burn through to generate such a small, declining amount of revenue.
It really is.
When you look at their cash from operations, they are burning negative $459.61 million a year. That's nearly $500 million just to keep the lights on and the research going. That is a blistering burn rate for a company of this size.
But, and here's where it gets really interesting, I'm looking at the balance sheet and I'm seeing a massive paradox.
Oh, the cash pile.
Yes. It is like looking at a startup that is bleeding $500 million a year, but somehow they just found a dragon's hoard of gold in the basement. Total liabilities are only $298.96 million against total assets of $1.41 billion.
Right.
Crucially, they are sitting on a $1.3 billion cash cushion. How does a company with shrinking revenue and massive losses end up with a billion-dollar war chest?
Well, we have to explain how that war chest actually got there, because it did not come from selling nuclear reactors.
Right.
It was massively bolstered by a recent $750 million ATM share sale program.
Okay, break that down. Explain the mechanics of an at-the-market offering. How does that affect the person holding shares right now?
So an at-the-market offering, or ATM, allows a company to essentially print new shares and sell them directly into the open market to raise cash.
Like printing money.
Basically, think of the company's total value as a pizza. They didn't make the pizza any larger. They just cut it into millions of smaller, thinner slices.
And then sold those new slices.
Exactly. They sold those new slices to raise that $750 million. So yes, the company now has a massive cash cushion, but they built it by diluting the ownership value of every single existing shareholder.
I have to push back on the negativity there, though. I mean, doesn't a $1.3 billion cash cushion make that terrifying burn rate entirely irrelevant for the short term?
How do you mean?
Well, even if they are burning $500 million a year in operations, they have nearly 3 years of runway sitting in the bank right now. Doesn't that completely de-risk the company from bankruptcy and, validate that $9 price floor?
It buys them time, which is valuable, absolutely, but it does absolutely nothing to solve the core business problem. A company cannot dilute its way to profitability.
Fair point.
The market looks at that $1 billion and says, great, you won't go bankrupt in 2026. But then it looks at the shrinking revenue and asks, what are you actually building with that money?
Right. Where is the growth?
Exactly. A cash cushion is a defensive mechanism. It is not an offensive growth strategy. Eventually, if they cannot turn their operations into positive cash flow, They will reach the end of that runway. And when they do, they'll just have to launch another ATM offering, diluting the shareholders even further.
So we have a company burning $500 million a year, but sitting on a massive defensive cash pile. When the math is this contradictory, how do the Wall Street professionals actually agree on a valuation?
They don't. They really don't. The smart money divide here is one of the most drastic I have ever seen.
The analyst consensus right now is technically a hold. You've got 36% saying buy or strong buy, 45% at hold, and 18% at sell or strong sell.
A completely mixed bag.
Yeah, and the average price target is $20.96, but the underlying spread is wild. You have Citigroup saying the stock is worth maybe $11.50, and then you have Bank of America with a price target way up at $28.
That kind of extreme spread tells you that institutional analysts fundamentally disagree on what kind of company NuScale actually is.
And the automated models hate it too. Simply WallSync uses a discounted cash flow model and claims the intrinsic value of the stock is barely $7.96.
Making it significantly overvalued right now.
Almost 47% overvalued. But then the bulls argue the fair value is closer to $20.73 based on future catalysts. Why does a discounted cash flow model hate this stock so much?
Well, a discounted cash flow model, or DCF, is a very cold mathematical way of valuing a business.
No emotions allowed.
None at all. It looks at the actual free cash the company is generating right now, projects it into the future, and discounts it back to today's value. Because NuScale is generating massive negative cash flow, the DCF model punishes them severely.
It's just looking at the math.
Right. It essentially assumes the company is destroying value every day its doors are open. The bulls, however, are throwing the DCF model in the trash.
They don't care about the current math.
No, they're valuing the narrative. They are trying to price in the future potential of a revolutionary technology that just isn't showing up on the balance sheet yet.
But wait, if that narrative is so revolutionary, why are the company's own insiders running for the exits?
Oh, the insider selling.
Yes, we are seeing heavy, undeniable selling from the inside. Fluor Corporation, which is a massive 10% plus owner of the company, dumped shares at $9.30 just a few days ago on April 9.
Right near the bottom.
Exactly. And company executives have sold over $8.2 million worth of stock in just the last 90 days. If this company is the future of global energy, why are their own executives and biggest backers selling right near the absolute 52-week low?
I mean, that is the most glaring red flag on the entire board. Now,
Yeah.
to be objective, insiders sell stock for many mundane reasons, right?
Sure, buying a yacht, paying taxes.
Yeah. They might need to pay a tax bill, buy real estate, or just diversify their personal wealth. But when you see a major institutional backer like Fluor Corporation liquidating a significant position at a 52-week low, you have to analyze the psychology of that trade.
Because if Fluor believed Bank of America's $28 price target, they would just hold the stock.
Precisely. If the people with the most intimate behind-the-scenes knowledge of the company's daily operations, their engineering bottlenecks, and their future contract pipeline are willing to accept $9.30 a share to get out.
You have to ask what they know that the retail trader doesn't.
Exactly. This is the textbook definition of a value trap. A retail trader looks at the historical chart, sees it used to trade at 57, sees it now at 9, and assumes they're getting a massive discount.
They think it's a bargain.
But the insider looks at the daily operations, looks at the cash burn, and decides $9 is a very fair exit price.
So you have a major analyst saying the company is worth almost $30, and you have the insiders themselves saying, get me out at 9. It sets up the ultimate bull versus bear debate for NuScale's future.
It really is a tug of war between two entirely different timelines.
So what does this all mean for the person trying to make sense of this? Let's lay out the bear case first. The worst case scenario where the stock continues to bleed. We already talked about the hundreds of millions in operational cash burn, but then there is the timeline of their product.
The deployment delays.
Yeah, they are facing major project delays. Their first commercial deployments of these nuclear reactors aren't projected to happen until the early 2030s.
Which is an eternity in the stock market.
And worse, they have this dark cloud of pending securities fraud class action lawsuits hanging over them. Why do these lawsuits actually matter if they haven't even gone to trial yet?
Well, whenever a high-flying stock drops 80 or 90%, class action lawsuits almost invariably follow. Investors get furious and look for evidence that management misrepresented the company's capabilities or timelines.
This happens a lot.
Right. For a typical company, these lawsuits are just a financial drain. Annoying, but manageable. But for NuScale, the damage is existential.
Because of the industry they're in.
Exactly. They are trying to build cutting-edge nuclear technology. Their actual currency right now isn't just cash, it is trust. They need trust from regulators, trust from future clients, and trust from future investors to fund that billion-dollar burn rate.
And a lawsuit kills that trust.
A sprawling securities fraud lawsuit shatters that trust and becomes a massive distraction for the executive team.
But then you have the bull case. The best case recovery scenario where this stock rockets back to $50. NuScale isn't just some random green energy startup. They are the only U.S. company with a design for a small modular reactor, an SMR, that is actually approved by the Nuclear Regulatory Commission.
And we really cannot overstate how massive that is. Securing an NRC approval is a grueling process.
It takes years, right?
Years of rigorous testing, endless environmental and safety studies, and hundreds of millions of dollars. It creates an incredibly deep regulatory moat. No competitor can just wake up tomorrow and decide to copy them.
They're essentially locked out.
Right. That NRC approval is a genuine, undeniable asset that holds immense value.
Plus, they have industry tailwinds. There's recent UK government SMR funding pumping into the sector. But the real wildcard, the absolute hype engine driving this stock right now, is AI.
Oh, the AI data centers.
Yes. The CEO recently reported they have signed 5 exploratory non-disclosure agreements, NDAs, with massive hyperscalers to power their AI data centers.
And there we have the collision of two completely different industries.
This is exactly what I want to ask you about. We have to weigh the immediate, visceral hype of AI data centers against the cold reality of a 2030s deployment timeline. Is the market fundamentally mispricing the amount of time it takes to actually build a nuclear reactor?
It absolutely is. I mean, the tech industry, the hyperscalers driving the AI boom, operates on a timeline of weeks and months. The AI arms race is happening right now.
They need power yesterday.
Exactly. They need gigawatts of reliable, clean power today to run these massive server farms. But the nuclear energy industry operates on a timeline of decades. You do not just print an SMR on a 3D printer and plug it in.
Right. It's not a consumer electronic.
No. You have to conduct site-specific environmental impact studies, navigate local zoning laws, secure specialized materials from a constrained global supply chain, and adhere to incredibly strict safety regulations before you ever pour a single ounce of concrete.
You can't just move fast and break things when your product involves splitting the atom.
Exactly. So while announcing 5 exploratory NDAs with tech giants sounds amazing on an earnings call, an NDA is just a promise to have a secret conversation.
It's not a contract.
No, it is not a binding revenue-generating contract. The bulls are pricing the stock as if these AI data centers are going to be plugging into NuScale reactors next year.
While the bears are looking at the calendar.
Right. The bears are looking at the calendar, looking at that $500 million annual cash burn, and wondering if NuScale will even be a solvent company by the time the year 2032 rolls around.
Man. So bringing the technicals, the financials, and these colliding narratives together, what should we be watching out for next? In the immediate short term, we are staring down a massive catalyst. Their Q1 2026 earnings call on May 7.
That May 7 earnings call is going to be the absolute crucible for this stock. Management can no longer just point to the NRC approval and smile.
They need answers.
They're going to have to answer direct questions about why their insiders are selling at the bottom. They're going to have to provide a transparent update on their cash burn. And crucially, they have to show concrete progress on those AI data center NDAs.
And if they don't?
If they walk into that call with more vague promises and extended timelines, the market will likely punish them severely. Momentum traders will bail.
And looking long term, their survival completely hinges on managing that cash burn while navigating those intense regulatory and construction hurdles to actually get a reactor built.
But if we step back and look at the broader mechanics of the market, this raises a completely different possibility for the long-term outlook.
No. What's that?
We keep asking if these massive tech hyperscalers have the patience to wait until 2032 for NuScale to build these reactors. But what if NuScale never actually builds a commercial reactor as a standalone public company?
Wait, you mean a buyout?
Yeah. What if a trillion-dollar tech giant, desperate for clean nuclear IP to power their future, simply buys NuScale outright? They could acquire the company, take it private, and fund the rest of the R&D using their own massive balance
Oh,
sheets.
wow.
If you are a hyperscaler in an AI arms race, buying the only NRC-approved reactor design on the market might be the ultimate strategic acquisition.
That is a fascinating angle. If the stock price stays beaten down at $9, they become an incredibly attractive acquisition target for a tech giant that doesn't care about short-term cash flow. That is something entirely new for our listeners to keep an eye on.
It's the ultimate wild card.
Absolutely. Well, thank you for joining us on this deep dive. Remember, this was an exploration of market mechanics, not financial advice. So as you look at that violently volatile chart, you have to decide for yourself. Is NuScale the mispriced trade of the decade, or are you just reaching out to catch a falling knife? See you next time.